And good afternoon. Welcome into Market Talk. We are live for the NCBA Trade Show and Cattle Industry Convention in Houston, Texas. Thanks for joining us today. I'm your host, Jesse Allen. Find us online. MarketTalkAg.com is our home on the web. MarketTalkAg.com is where you can find us. All of our social media links are there. Our streaming sources, everything can be found on our website. You can find all of the latest news of agriculture and much more there. It's all at MarketTalkAg.com. Well, plenty to talk about in the markets today. We were well off the highs in the grain trade. Let's bring in our good friend Mike Zuzolo with Global Commodity Analytics joining us this afternoon. Mike, good afternoon to you, sir. It was a wild ride in those markets today, as you and I were talking before we jumped on air here today.
Yeah, it really was. And it kind of reminds me of a couple times we've talked before, Jesse, where the soybeans continue to really lead this market higher, but then they get into some low oxygen areas, some high altitude areas with thin oxygen levels, meaning new buyers not wanting to come in most likely. And I think a lot of that goes back to the spread trade that we continue to see. We're really working hard, buying beans and selling corn, buying beans and selling wheat at this point. And this continues to be a real fundamental head scratcher when it comes to how is this market going to feel once we get to the February WASDE report, and how's this market going to feel once we see USDA's first acreage number coming out here very soon with that agricultural baseline 10-year outlook meeting coming up here towards the end of the month. I think it's around the 23rd, 24th, somewhere around there. So I think this is a market where I'm really still kind of locked into the idea that these are just too good of prices for soybeans to give up. I'm not going crazy or getting real extreme. Taking a very conservative approach as far as how I market. I'm still not over 30% sold at this point on 22 soybeans, even though I've been talking about it for 2 weeks now, getting a lot more done. And especially now that we're in this February base price time period for the crop insurance, I really just don't want to mess up a really good thing, especially given the signals that the wheat and the corn are giving me right now.
Well, when we look at those markets today, across corn and wheat, we were down pretty hefty. Soybeans, we were off the highs. Was it a case of we just got too overbought with all the new money that flowed in yesterday to start the month? Was it just a lot of spread trading today? What are your thoughts overall?
Yeah, I think it started with Tuesday's trade. We had very strong volume in the soybeans on the rally, but the rally in corn and wheat, our volume numbers were way lower than Monday's trade. And so that was a real red flag to me. I think the other thing that came in on today's trade, a couple things. In the case of the corn, we just had an unbelievably tough ethanol week again. And in the case of the wheat, we saw, I think, a little bit more of the hard red wheat belt get quite a bit more snow. Soft red wheat belt is still looking at a very good snowpack. And this snowpack could last all the way into the break in dormancy as we get into March, April. And so I think we just had to price those things in as we got here to the midweek.
I want to pull up the November bean, December corn chart. I want to talk a little bit on new crop. We are seeing good strength in the new crop markets as well as the front months. Talk to me just a little bit about this chart and some of the things that you're seeing when we start thinking about some of those new crop contracts.
So this is a great chart for this week, Jesse, because I haven't told you this yet, but you notice the chart when I sent it to you mid-session was it trading at 2.35 times November beans premium to December corn. We're going to close this guy out at 2.43 today. So we are well over my red line. It's kind of like an RPM gauge. Historically, in my opinion, the analysis I've done is you go over 2.4 beans premium to corn and new crop, especially this time of year, you start to really attract some attention. And without even talking to clients yet about this spread or this ratio, I had calls this morning, and then I had another call this afternoon from producer clients talking about the new crop beans and how they can get a hold of this price and maybe switch a few acres around. So I think we are in this market bringing in more bean acres. And this is a wonderful time to be doing it because it's helping us with our average price on the crop insurance side. But I would stress one thing. The big difference between corn and beans right now, the, I guess, biggest difference in my mind is the corn market doesn't feel as though we really need to ration demand in South America. And so they've got a soybean supply issue where if you add Brazil and Argentina's production together, and we talked about this last week, we were probably trading around 180 million tons for production. I think the trade now is down closer to 170 million tons, Brazil, Argentina, soybeans combined. That gets you right close to the production levels of 2016, 2017. If I'm right about that, then we are trading probably closer to a 65 or even maybe lower ending stocks figure here in the world soybean stocks. What makes me say that? Well, because the soybean price in Brazil, the soybean price in the United States, and the soybean price cash in Argentina are all trading around $600 to $625 a ton. The last time we were that high on cash soybeans around the world by the three biggest suppliers was back at late 2012, early 2013, when those soybean ending stocks were around 64 million tons. So the trade is clearly worried about the supply side on the soybeans by what this chart's doing, and clearly, in my opinion, not worried about the corn. And I think they should be.
Yeah, and I think as well, I would agree with you on that one, Mike. Is this is just, we talk South America and we look at the tightening balance sheets, and it's just very, very interesting. And I know you have this Argentina crop map as well. Since we're talking South America, I want to pull this up. We've seen some private estimates this week have really dropped their numbers in Brazil and Argentina. And I feel like that's maybe been a bit of the fuel to the fire, so to speak. But talk through this map and talk a little bit more about the latest you're hearing out of South America.
Yeah, let's really boil it down to the listener and the viewer right now. I mean, we have got a USDA corn production number in Argentina of 54 million tons. We're about a week away from the next WASDE report, and the trade, as you said, is dropping below 50 million tons, and I'm dropping below 50 million tons as well. Why is that? Well, in part because of this map right here. This is an Argentine vegetation crop map, crop intensive areas compared to last year. And you're looking, the black circle is Santa Fe and Cordoba provinces. They make up 35 to 40% of the corn crop every year. And you can just see very easily how much more brown there is right now versus where there was last year. Last year, Argentina did 50.5 million tons. So, Jesse, right now, USDA at 54, last year at 50.5, it's not hard to see a 50 or sub 50 corn crop in Argentina. So put that together with what they're thinking about in the beans, what they're doing with the bean corn ratio. And from a guy that loves to manage risk and lock in profit per acre, it's not hard to go after the soybeans here and leave the corn alone.
Well, looking at corn as well, I'll flip over to ethanol stocks here today. We got those numbers. We were up again this week, a little over 5%, I believe. And I would have to think that these ethanol numbers probably going to be a little bearish for this corn market in short term. What do you think?
Yes, I agree. And I think this is where we're really going to have to watch the basis levels for the nearby corn, because I could really see a kind of a, I think we talked last week maybe about the spread in wheat. Maybe hard red wheat gets bought, soft red wheat gets sold because of the weather pattern we're in. It still looks that way to me this week with the 16-day models still looking very, very dry for about 70% of the hard red wheat belt. Be that as it may, I could see a similar type sentiment set up here with these bigger domestic supplies of ethanol, highest since April of 2020, the first big wave down in COVID, when COVID hit, and that's when we took crude oil negative. So this is a big deal, being at stocks levels not seen since April of 2020. So I could see the spread in corn really starting to collapse here, Jesse, as we get closer to the March 30th stocks report, if we don't see something big come out of the USDA with the February baseline numbers, or especially the WASDE report, kind of like what we were just talking about, where South America, we see a big cut in the ending stocks for Argentina, and maybe a decent cut for Brazil, because southern Brazil is still very dry in parts. So I think this is a kind of a warning flag to me that while the Dees corn still seems undervalued pretty substantially at this stage, not so sure the new crop or the old crop corn March, May is going to be able to hold up too well here without getting that bull fed a little bit here in the not too distant future.
Let's talk the wheat market a little bit here, Mike. I know parts of the plains getting a little bit of moisture here this week from this winter storm that's working through. I know more of the snow and whatnot is moving through the eastern Midwest. But looking at the wheat markets today, we were down pretty hard along with corn. I know we're still watching the Russia Ukraine tension. Seems like maybe a little bit of that's eased, at least in the news cycle. But what are your thoughts with wheat? Was this more of just an overbought correction today?
Yeah, I think a lot of this does go back to what you originally talked about when it came to the funds. I think the funds have been very eager to dump their wheat positions just because they've been holding them quite a bit of time. And the monthly charts, when we closed out January, Jesse, that monthly chart just did not look that great in soft red wheat, and it didn't look as bad in hard red, but they looked vulnerable, I guess is what I would say. I would also say when it comes to the Baltic side of the equation, I thought the neatest statistic that came out on Wednesday when it came to wheat, or the neatest fundamental factor, was Ukraine reported their year-to-date exports for 21-22 crop year up to almost 39 million metric tons year to date. That puts you up 32%. They have booked out and shipped out a third more wheat than they did last year at this time. So I think that had to have worked some into the market sentiment, and I think that's a big reason why the European wheat market was very ready on Wednesday's trade to follow the U.S. market lower. And when it comes to the Ukraine and Russia, I really think we've got to watch this very closely, because I saw natural gas up 15% on Wednesday's trade. I don't think that's all just weather. I actually think with the U.S. sending troops, and probably more troops, what I could hear in the Department of Defense press conference, it sounded like more troops than the original number going into through NATO. I think this is still a red hot, red button issue that could really change this dynamic in the wheat market very, very quickly. And so, all that being said, when I look at the dollar breaking, when I look at the Ukraine, Russia, when I look at the weather, I think wheat continues to be my leader. And that's why I'm more eager to hedge beans on this rally, because the wheat's not showing me the strength that I really want it to right now.
On the Russia front as well, one other note, I know yesterday they announced they were banning exports of ammonium nitrate for 2
Right.
months starting today. Do you think that's had an effect on the energies and subsequently on the grain markets today?
I do, and I think it's interesting. I haven't seen today. I forgot to look before we went on the air, but there was a massive fertilizer plant in, I think it was Winston Salem, uh, Carolinas, that was potentially going to blow, and it was much bigger than the one that blew in Texas. I think it was in 2013. These are all going to play big roles in the fertilizer prices, just because the issue is so strained and the supplies are so tight in certain parts of the world. But yeah, I think this is where the natural gas, to me, the corn and the natural gas relationship with one another, that correlation that I keep watching, it's strengthening again between natural gas and corn on like an 18 or 20 week basis. So I only see that continuing to be a source of what drives in part what the corn does. But for right now, the corn is really taking its lead from the wheat still, and it's really the short side of spread. So we can't underestimate a short covering rally potential in the corn, especially in new crop, if USDA comes in with some different numbers and what the market's kind of baked into the price.
Let's talk livestock. I want to start with the hog trade. I know you talk a lot about the pork and bean trade. Hogs today were higher though. We had some good strength, minus maybe a little spread trade with that February contract. But seeing beans higher, and I know meal fell back a little bit, but seeing hogs higher as well along with beans. Talk to me a little bit about this hog market today and what you saw there.
Yeah, you parsed it out really nicely. The February market in hogs, I think, is backing off here, and the longs are kind of jumping ship and not really wanting to build new longs. Why? Because we're in the month of February now, and we've got a 3+ premium in Feb futures against the cash index. And I think the market's a little bit nervous about the pork side of the equation here. And I think that's where Thursday's export sales are going to be really, really important to the overall hog market sentiment and the complex as to whether we can go on up to higher highs. And it got a boost from the cattle inventory report from last week. And so that really helped. And that helped the April, especially. April hogs, though, they're kind of unleashed at this point, not just because of the cattle report, but as you said, because of the pork and bean trade and that soybean complex. It's hard for the hog funds, I think, not to just jump in when they see the soybeans doing what they were doing this morning.
You mentioned that cattle inventory report as well, and I feel like that's still being digested a little bit by the cattle markets. We've seen more good strength today. cattle country. We're starting to pick up some bids in out in the feedlots there in the plain states, even with the winter storm working through. So talk to me about this cattle market. I mean, feeder cattle 170s, 185 out in the August contract. I mean, live cattle trade, we're in the 140s. What are you seeing in this cattle market right now, Mike?
Well, we could tell that the feeders were holding back the fats at times, probably up until this past month. And then when we got the
Mhm.
cattle inventory report, we saw the dynamic, as you say, change in the sentiment of the trade. And it seemed as though the feeders were being then held back by the fat cattle, and the fat cattle wouldn't trade. But then all of a sudden, we saw that Yankton, South Dakota trade. I think it was on Tuesday late, and it was 140 plus. We did have a little bit of business on the central stockyards at 138.75. But I think you're right. This is where the market has not really been able to get its arms around what that cattle inventory report said, because I was projecting 1% lower on beef cows that had beef cows that had calved, and also total inventory numbers. Was not expecting 2% lower. And so now it really makes me wonder, how much more liquidation could we actually do? And we can liquidate if it stays drouthy, but it just raises the question of the pace of liquidation at this point, Jesse. So I think that put on notice for me anyway, are these placements coming in the future cattle on feed reports going to be as big as I think they are because of the drought? They probably can't be at this point with this herd being down so low already. So I think that's why the feeders got a little bit more of a bounce to them. Now, having said all that, while I think the fat cattle are close to getting the need to get some hedges in place for the Feb and even the April, and I'm not doing it yet, but I think we're close. The feeder cattle, I think we're really in the red zone, because, as you said, we've got a March feeder contract that's trading 166, 167. We've got a gap from the January 3rd low in March feeder futures just above 169. But all of a sudden, you go back and you look at that March CME feeder cattle index, it's all the way down at about 159. You're essentially building in an $8 to $10 premium in futures. Whenever I get that, I really start wanting to hedge, because that's one of those things where most likely, in my opinion, either the futures is going to go down or the cash index is going to go up. And you really have a nice way to balance your risk that way.
Well, Mike, normally you and I are up against the clock on a Wednesday afternoon. We got a little bit of time. Stage is yours. Anything else you want to touch on today?
Well, I think the thing that I'm working on most is trying to get an idea of the acreage base. And when I talk to clients about this for 2022 here in this country, it seems as though it's really going to depend more and more and more upon what the base price is for crop insurance, Jesse. And so there is more leeway, I sense, this year than I've sensed in probably 10 or 15 years. And I've been doing this 27 years, and I can't remember a year where it's been like this. 2008, 2009 was somewhat like this. But I think this is where it's really hard to get a good acreage base set up here in early February. And I think it could be quite a bit different number by the end of the month. I think the other thing that I will close on is the idea that we can keep up with the demand at these price levels for soybeans. If these prices stick around as high as they are right now, I just don't think it's possible, and it's not historically likely. And I also feel like we started out way too high on the crop, and now we're going way too low, with probably 15% harvested now in Brazil in terms of soybeans. So I wouldn't doubt that the later beans maybe perform a little bit better. I think that's something you need to bake into your risk plan.
Well, Mike, I know as well, if folks need some advice, they can reach out to you, globalcomresearch.com. Sign up for a free trial. You have a lot of great analysis they can check out, or they can find all your contact info there easily, can't they?
Yes, they can. And I'll be doing some seminars around the cattle belt. And for clients especially, I'll be posting those as webinars as well. So consider that too.
Global Com Research, Global Com with two M's, research.com. With that, Mike Zuzolo, thank you for joining us on this Wednesday, sir. We will talk to you next week.
Great to be with you, Jesse.
Mike Zuzolo joining us today here on Market Talk. That's going to do it for the show here live at the NCBA Trade Show and Cattle Industry Convention in Houston, Texas. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.